Hello, everyone, and welcome back. This is the Cutting Edge of FinTech track, sponsored, of course, by Citadel SPV. And we are honored to have Yoel Gavlovski speaking with us today on how alternative data can be used to serve the underserved. A couple of just really quick reminders. Networking Roulette is this afternoon at 5 o'clock Eastern. You know how to sign up for that. If you don't, you haven't been paying attention. Book your meetings, because that's why you're here. There's 700 fintech leaders in the audience today. Now's your chance to go and book the meetings. When you navigate away from the screen, you will find that we follow you. So the video is going to stay pinned up and you can listen to us talk, then come back and interact in the chat and the Q&A, which you can only do through the live stream tab. So let's kick it off. Yoel, how are you today?
Hey, Wo, how are you? Great seeing you back since last year in Miami.
Yes, you killed it in Miami last year. I'm not going to go fishing for compliments, but I understand you had a really good conference with us in Miami, and I'm glad to hear that.
Definitely, yeah.
Let's kick it off just to give the audience a little bit of a grounding here. Tell us briefly, what does QUASH AI do?
So QUASH is helping financial institutions in Latin America to lend to their underserved but credit-worthy borrowers by using more than 700 alternative data points and auto machine learning.
And I'm sure we're going to get into the how on that, because that's obviously easier said than done. But let's talk about market size. They were in the keynotes this morning. There was a lot of commentary about the market and how it's composed, how large it is. How do you view the market?
Yeah, so when you see first the US space, you find around 20 to 30 million US citizens that currently have a lack of access to credit, no file, thin file, or thick file borrowers. But when you go to Latin America, there are 500 out of 600 million Latin Americans that do not have access to credit. They do have bank accounts, but they lack access to credit. And it has been proven around the world globally that at least half of them could qualify to some sort of loan once you have the right data on hand.
So it's more than 10, maybe 15 times the market size of the US in terms of number of people. And we could talk about dollars and pesos and things like that, but it's a vastly underserved market, clearly. Let me also note, actually, and maybe you can comment on this. How do you look at that total addressable market in terms of dollars? And the reason I ask that is, as you start to repair the economy or fix the underbanked problem, the economy itself grows, right? So is that a part of the calculus that you go into when you measure the size of the opportunity?
Yeah, no, the opportunity is huge. We are speaking about plus $20 billion industry, where you basically initially start by just giving access to credit, but then it translates. We're working since the beginning. We have been working with most of these, also not only banks or financial institutions, but also these big retailers that lend, where you can start combining all of these behaviors that they're understanding on the retail and e-commerce world, but also with now the evolution of credit as well. So both industries at the end of the day merge, and that's what it gives them, not only giving them out conventional loans, but everything will pivot. And initially you start seeing typical loans of, that you can give them for 5, 10, 20 years or more in terms of mortgages. But now you are seeing a lot of different new trends to give them a wide variety of financial products based on this new revolution that it's happening.
And so let's dip our toes into a little bit of the how. And since machine learning is a pretty complex topic, when we get into the nuts and bolts of it, of course we can all theorize about it, but give us an analogy to work with when it comes to sort of what QUASH does for financial services in a way that simplifies what you do.
Yeah, so basically what we do in a nutshell is that we partnered with around 700 data sources. And what we do is that we identify, it's too hard for financial institutions to identify, independently of how big they are, the right path or the right sequence in which they should start testing alternative data and their and predictive capacity in a profitable way. But because normally 99% of the people, when they start understanding about alternative data, they think that, oh yeah, Quash has 700 alternative data points, let me try them this month. But it's unrealistic. Why? Because proving the profitability of adding one alternative data point, it could take you 1 or 2 or 3 months first, because you need to start getting the confidence that you are spending the least with the maximum ROI. Once you start gaining confidence, then you can go scaling and automating in order to accelerating the way you add not only data scores, but new predictive rules from pilot to credit policy.
Okay, so it's a little bit like a sophisticated filtering system where you have the platform, you have the data, but then it's not just a free for all. You need to help guide your clients about exactly how, it's not just how to use the data, but where to start, I guess, in terms of the using the technology. Am I getting that right?
Okay. Yeah, correct. We give them the data, the raw data, but if they need help in converting any source of data into credit data, we have a platform that does that. And today we have processed already more than 30 million loans in 10 countries in financial products in Latin America. And we expect by December of next year in this conference to hit more than 100 million loans processed. And with that, we are understanding the right sequence on each market and on each financial product that these financial institutions should start tapping into predictive or alternative data. So that's the way we do it.
Okay. So you have a vast pool of data, but then a real almost like a consulting side of it. It reminds me of the early days of Facebook advertising when we used to advertise on Facebook, and they had a consulting service that was free of charge, and they basically drop in and say, okay, you want to acquire this kind of client, here's the first filter you want to layer in.
That's an amazing case, because when you see, for those who know that case, which Facebook advertising does, is all advertisers basically their goal is to optimal goal is to find the profitability of which are the most profitable advertising campaigns. Obviously, Quash, let's just put a reminder, do not use any Facebook or social media data or we don't do any sort of enrichment with data without the right consentiment and explicit consentiment of users. But just as a framework of how you explained, in a way that similarly to how advertisers create advertising campaigns to prove the profitability of adding new profitable campaigns based on ROI, now financial institutions should have a budget in their credit risk teams. I just met last week with the first data enrichment team in Peru inside a credit risk team, which is the first time in the 200 meetings or 300 meetings that we had with financial institutions. So banks in Latin America are already creating internally teams of data enrichment, and we are helping, independently that they do have this department or not, identify and accelerate the way they test and launch these credit campaigns to prove the profitability of adding data and predictive alternative and data.
I'm sure you're very happy to find each other. So the data enrichment team, then, if that's new, if that's relatively new, how do they interact with you, or how do they connect their systems with yours? Is this an API service? Are you batch processing? What's that look like?
It's very simple. The first thing that we do is, instead of jumping straight to enrichment, we need to validate that they're using auto machine learning, because they need to maximize it's implementing the right way, passing from basic analytics to advanced data analytics in terms of credit risk, and implementing auto machine learning is crucial, and it's like the low-hanging fruit and the least cost. Actually, in Quash, you can test that auto machine learning predictive capacity for free for about 1/3 of a year. So we give out that in order for you to transition to do a natural path of transition, and we wait until they feel that the loans that they gave with this predictive capacity past the grace period and several payments, so that they can make sure that that they're not having an increase in late payers, and we correlate that late payers to potential defaulters. So they get a lot of confidence for free before they start paying in doing those sort of data enrichments. So yeah, back to your questions, everything is Quash is all about API calls. So we recommend data, scores, and rules. And based on the volume, the larger the volume, the better the price you get.
Got it. And then your clients can leverage you. You're learning from your clients. It becomes a virtuous cycle where you have a lot of positive feedback loops, and also can more adeptly consult with your clients. Okay, that makes sense.
Let me just clarifying something there. We do tropicalize the models uniquely to each customer, although we have experience of the aggregated power if you want to launch, for example, microloans in Central America in this market, obviously we have already our algorithms trained to that, and you can, instead of being just siloed in your credit risk team, you can leverage on that learnings. And back to your point, yeah, we obviously have that network effect of more data, better predictions, more loans processed, and so on.
Yeah. And obviously what you're trying to do within the risk profile, or on that spectrum to that buyer, you're increasing the ROI, you're increasing acceptance without increasing risk, or tightening the credit box, or what have you. Is there also when at least in the States, when fintech stopped lending except for the emergency PPP loans, a lot of the fintechs here needed to pivot in a sense and start to do portfolio management. Is there any kind of portfolio management that your algorithms can do in that sense?
Yeah, so that's an amazing question. What we see typically in Latin America is that financial institutions do not want to change their typical origination process. So they could have, FICO Analytics, Workbench, Experian, Parker, TransUnion, SAS, whatever they want, and we integrate simply in less than 30 minutes, like via an API modularly, so they can easily first prove that first predictive score that we give them out for free, and then we do they can actually do all this experimentation and visualization in the platform that we provide to them. So back to your question, if we do some sort of management or not, we additionally to allowing increasing acceptance without adding any additional risk with this alternative data and machine learning, and additionally to helping in collections in times of COVID, we once all clients matured in the way of having hundreds of thousands of clusters that match their risk appetite with validated and included in their risk policy, we then start doing some sort of, for example, upselling or cross-selling strategies to maximize the LTVs and ROIs. For example, what's the optimal point where you should upsell to this client? What's the optimal point where you cross-sell, or offer other financial products? And finally, we also allow and help in the digitalization process of automating approvals instead of just having all manual process.
So you mentioned that the data is gathered ethically. Obvious. I mean, we can assume that, but it's good to state it. Is that where the bottleneck is, in the sense that you are only as good as the data that you provide, and if you have to request permission for the use of data, does that become a challenge? Does that make a lot of potholes in the mosaic?
Totally. That's definitely the biggest bottleneck that financial institutions have had in the industry. But we have leveraged that and make it an opportunity. We did prior to Quash more than 4 or 5 years ago. When GDPR and CCPA regulations were starting, we were super into it. Where basically GDPR in Europe and CCPA, California Consumer Private Gag in US, are the two standards for all regulators in Latin America. So we know and we see how they get inspired into these two regulations. So what we did was going to the most rigid compliancy regulations in order to not have to change anything in the next 5 to 10 years. So the way we do it is that in both GDPR and CCPA, there are data processors and data collectors. So in the case of Quash, we only process data, so we can't handle any identified information. So financial institutions can't send us any identified information, and if they try to do it, we have a dynamic data inventory that prevents that to happen. And secondly, and most importantly, is that we don't do any sort of enrichment without the explicit consentiment of an individual. So individuals need to give out the explicit consentiment that they authorize to use those enrichment in order to maximize his chances to obtain that loan.
Got it. And I'm going to turn to some audience questions we have here. I know that you work with a very small motorcycle sales or lending company. You also work with some of the largest banks in Latin America. The question here is, what is the minimum data set that we need to start machine learning efforts? 50,000 users or what is really the question? That's
an amazing question. So typically, we start like in the minimum that we typically accept is 10,000. But we have seen some, these new fintechs that have raised significantly more amount of money that we have made some sort of exceptions where we start with them, but they're having triple-digit growth, and we definitely want to be there in those learnings. So typically these financial institutions provide over 10 million data points, 10,000 data points, sorry.
Got it. And then is there a lower segment where you just cut it off because it's not profitable? The question here is about microfinance. What are the, and what are the main variables that you take into account to analyze these type of clients? So it's sort of a two-part question. One is, go ahead.
No, that's the question. I don't know if we went there, but we combine the question. I'm going to answer it in microfinance or in any other type of loans. It can be credit cards, small and medium business, could be mortgages, and so on, individual loans. So specifically, we have the specific sequence per financial product, which I'm not going to go into the details today. Happy to meet and show it to each financial institution what they need. But in general, we are the largest aggregator of open banking that have already launched in Latin America. We're true believers of them, where we already access to these, generic APIs, contextualized banking information. Today they combine 150 banks. Next year they'll have at least 1,000 banks. So it's going to be a huge explosion in terms of that data. But we also connect to most of the telcos in Latin America. So for example, if somebody's prepaid in terms of top-up minutes, potentially he doesn't appear in the credit bureau. So instead of measuring not only the ability, but the willingness to pay a loan if they recharge 3 times in the last 90 days, or for example, we have almost 100% of the IPs and VPNs in Latin America, so we can know who belongs to the top 5% of the most internet connection. We connect to LinkedIn to know what type of role, what type of industry, what type of employment, when was the last time he changed job, and so on. So those are 3 or 4 out of the 700 alternative data points.
Yeah. And just like anything, it's the Pareto principle at work. I'm sure it's even more extreme than that, where there's going to be a couple of data points that really, really make a difference. We're coming up on our total allotment of time. Is there anything, Yoel, that we missed that you'd love to impart to the audience? The floor is yours.
Thank you so much for having me today. Obviously, always a pleasure. Let's basically, at the end of the day, this has a huge social impact that we need to remember always, that by having the opportunity to, now we have the data. So it's a perfect timing to really, expand the financial inclusion in our region, and it's in our hands, in the hands of everybody that is today here to make that happen, which will trigger and will make the difference of somebody that will be able to send money to his family, to start a business, to pay for education, for medicines. And so obviously more than happy to meet. You can find me out to my email, which is yoel at quash.ai, or ask for a demo in Quash, the QUASH.ai, to set up a meeting.
Great. Thank you, Yoel. And of course, Yoel is here at the conference and ready to meet. He and his team are consummate networkers. I would be shocked if they aren't on the leaderboard as a unit. They're killing it with their meetings. Thanks again for joining, and we'll see you during the rest of the show.
Bob.
You bet. Thank you. So just a few reminders. We're gonna take a short break in just a couple of minutes. We'll put the countdown timer up. We have networking roulette coming up at 5 Eastern. Reminder: book your meetings just like Yoel does. It will change your life. And next up, we're going to be talking about the new financial infrastructure driving fintech forward. We'll have eBanks, Hash, and Belvo on. And Mike Packer is going to be the moderator there, Mike Packer of QED Investors. So with that, we're going to wrap, and thanks everyone. We'll see you here very shortly.